Hello everybody and welcome to this week's Markets to Watch from Smack the Markets for the 18th of May. So we start off this week with, well, quite a bit of optimism in the markets. We've got a number of regions in Europe starting to ease their lockdowns and starting to reopen their economies, particularly Italy and Spain, which have been pretty hard hit with the coronavirus. We've also seen Mr. Powell speaking on Friday, seemingly discounting the use of negative rates within the world's biggest economy, and that expectedly is having quite a bit of a relief rally in many US related markets as well. So let's take a look at a few markets here that we're keeping an eye on at the beginning of this week and some of the opportunities that we're looking out for. So if we come across to the Dow first of all, and we'll take a look at the Dow future here on the daily chart. Let's just expand this a little bit. We can see that more recently, the market has now sort of formulated this sort of popular heads and shoulders pattern here on the chart. So we've got two shoulders, we've got the head up here, and we've had the rejection. And last week, the markets were looking pretty set to sell off and moved down here towards the sort of 23,100, didn't really sort of manage to get underneath. Well, it got underneath the 23,000, but it couldn't really sort of hold underneath there before pricing being pulled to the long side here. Now, one of the things that's really driving these markets at the moment is not only the fact of the optimism of the easing of lockdowns, and it's all very, very good news, of course, which is going to have a boost in many markets, but also the extent of the quantitative easing, which is seeping into the markets as well. So the one sort of warning, I suppose, is it's lovely to have a good rally, of course, but the word of caution is that there is a number of strong resistance levels above price for the market to get through, and there is a lot of negative news and very damaged economies around the world to contend with as the markets sort of roll forward. So I wouldn't be at all surprised in the next sort of few weeks to months that we start to see, some retesting of these lows. So I've always got that in the back of my mind. So if we come down to the 4-hour time frame, and you can see the sort of structure of the markets here a little bit more cleanly. So we've got our levels here to the short side, which was 23,300 and 23,100. You can see that how the market sort of respected those recently, even in recent price action. But now the market's sort of pushing up to our level here at 23,950 and 24,000. So above these areas, well, we've still got our levels in play, structure points up to 24,150 to 24,300. Getting above that, we've got that 24,680 sort of price point as well. So if the markets, from an intraday perspective, I'll certainly be happy to trade the markets long in between these sort of structure points, but keeping a very close eye on the price action around these sort of structure points. These are decision point areas where we may start to see some weakness coming in at any one of these. Now, of course, if we see weakness coming in and we start to see signals to the short side, I'll be quite happy to hold into those positions a little bit longer. So let's come and take a look at precious metals. So gold here, gold has really sort of managed to break out of this sort of range that it's been stuck in for quite some time. I think Friday certainly had the news on Friday was certainly gave the impetus here for the market to break through this and start to see the run to the long side. Now gold should see much higher prices in the weeks to months to years to come with the amount of stimulus that's been pumped into the system. So this is moving in the right direction now. So if we take a look at this, we can see that we've got this breakout. 1700 has certainly the support there has been now sort of rejected, and the market's moved higher. So coming up to the 4-hour time frame, we can see that we've got, well, 1744 was the sort of top end of this sort of sideways range. We're now sort of through that. 1760 up here looks like a reasonable level that the market may well retrace back into, and these sorts of areas here are the sorts of things that we can look for potential positioning. So if we get pullbacks into moving average geometry zones, back into structure levels, those are the sorts of areas where we like to acquire positions. At the moment, the market's looking a bit stretched. It's had a very good run since Friday, so some sort of pullback might give us those sort of opportunities for positioning. As I say, for gold, we could start to see some longer term prices higher, but of course we've got to be careful with the timing of positioning, because it doesn't mean to say that this market's going to run in one direction without looking back. If we take a quick look at silver, and here might be a little bit of a sign of some of the sort of challenges to come. Silver is a little bit different in the fact that gold is already above its sort of consolidation level. Silver here is below its consolidation level. So if you look at all this zone here where the market's sort of run up to and consolidated against, and silver has already sort of sold off pretty heavily from that. So now we're underneath that. So we've got all of this range here, all of these levels to get through for the market before it starts breaking out to the long side to make fresh highs. So bear that in mind. Gold and silver tend to be highly correlated. So maybe if one starts hitting the brakes and bricks walls, that might start to put a little bit of pressure on some of the others. Silver is also looking very overextended at this moment in time. So let's come to the currency markets now, and one that we're keeping a very close eye on here is the Kiwi dollar. So this is very much geared around a US dollar strength play. So the Kiwi has been particularly weak for quite some time, particularly against the dollar. If the US dollar strengthens, then we could start to see extended weakness coming into the Kiwi here. So if we take a look at the weekly chart, you can see last week's very bearish candle formed here within the sort of moving average zone. The market just at the moment hasn't broken last week's the low of last week's candle just yet, but it's not far off it. And I think if we start to see some advancement below last week's low, then I think we could start to see some picking up of sell orders here. We just take a look at this on the daily time frame. You can see in here you can see where the market is. We've really sort of got a topping formation here now on the daily time frame. We can see the level through here, which the market sort of tested multiple times. It's not just been last week, but there's also a number of sort of levels, a number of times this market's tested this zone. So break below this sort of area, things are going to start to look rather nice to the short side. The momentum is already started now to indicate weakness to the short side here, or strength to the short side. So we come down to the lower time frames and take a look at this on the 4-hour time frame. Let's just sort of take a look at this in the context of things. You can see where we are at the moment. We've already got a short trend formed here on the 4-hour time frame. Break below the low here, the current sort of low in price, takes us through a very precisely tested level. This also ties in with last week's low. It also ties in with the break of that level on that weekly chart and the daily chart as well. So that really does sort of open up and sort of get through a lot of key support on this market, and could sort of fuel more opportunities to the short side. So keeping a close eye on the Kiwi dollar here for shorter prices and a continuation of this trend. And of course, this is a US dollar strength play. So there's a few markets there that we're keeping a close eye on in the trading room coming into the beginning of this week. I certainly hope it helps, and speak to you next time. Bye for now.